Tesla is slashing prices again on its cars. According to a report today in the Wall Street Journal, Elon Musk's car company slashed the price of the baseline Model Y by almost 20%. It cut the price of its high performance version of the Model 3 by 14%. This seems to be in an attempt to get these cars to qualify for the $7,500 federal tax credit that's coming in, that's arrived in 2023 for US buyers. This follows price cuts it implemented in China already in some of its models over there, and several rounds of price cuts in that region. And so this raises the question again, like I've been talking about. If you've been following my channel for the few months that I've been on YouTube, I've been saying since the beginning that Tesla is going to face trouble from competition. And everybody kept telling me, no, Tesla's the best in class. Nobody can touch Tesla. Tesla's got the best cars. It's got the best this. It's got the best that. And I kept pushing back and saying that might be true. Tesla might be best in class. And I would agree, Tesla has the best in class gross profit margins. But that doesn't mean that competition will not hurt Tesla. And you're seeing evidence of it right now. Tesla needs to slash prices because of the competition, because there's other cars in the market now that consumers can choose when they're looking for an EV. They don't need to go with Tesla. That increasing choice makes it more likely that someone's going to choose a car that's not a Tesla. This is especially true because Tesla's been rolling out essentially the same design on the same car for the past 5 years. Whereas the newer models are coming out with sleeker designs, more desirable designs, and newer models that's attracting some of these consumers that want EVs but don't necessarily want a Tesla. Furthermore, now that Tesla's lowering prices, and this is the other side of the equation that I've been talking about, is competition has been hurting Tesla in terms of the supply side. Acquiring the materials becomes harder when you're dealing with competition, right? Because now you've got 5 to 10 other companies that are making EVs in large scale, in larger and larger scale, that now Tesla needs to compete with when they're going out to buy these materials, when they're going out to secure labor, right? So now the costs of those things are going up. Meanwhile, the prices are coming down, and that's a terrible equation for investors. This is what I've been highlighting on my channel for several months now, and why I'm not enthusiastic about investing in EV companies, even though I agree the EV industry is going to grow and it's going to continue growing over the next several years. That can be true, and it also can be true that it's not an attractive place to invest in because of the fierce competition and the lack of sustained profitability. So let me show you this other thing and what this means for investors. Tesla's price cuts. So here's Tesla's gross profit margin quarterly going back before 2019. And this is what I mentioned earlier. Tesla is the best in class in terms of EV companies earning a gross profit margin. You could see a very nice upward trend, demonstration economies and scale. Excellent, excellent. I love to see this. But what's troubling is more recently it's coming down. And more recently is when more of the competition has started ramping up production and highlighting increasing costs of goods sold. And you could see Tesla's gross profit margin has been falling. And now with these 15 to 20% price cuts, it's going to hurt this profit margin even more. So it's already coming down. The cost of goods sold is already coming up. Now the prices are coming down. Now this gross profit margin is going to be extremely under pressure. I would not be surprised if this gross profit margin falls below 20% over the sometime in the next 4 to 8 quarters, which is not a good sign, which is not what you want to see, especially because one of the good things about Tesla has been the rise in its earnings per share, but that's mostly been an impact since the pandemic. The popularity of EVs exploded because mostly legacy manufacturers had difficulty securing the semiconductors and materials and labor they needed to ramp up production. Tesla benefited from that and got a huge boost since 2020. It was rarely ever profitable before then, and then since the outbreak, it's been exponentially growing its earnings per share. But that can be in question now that its gross profit margin is falling and it's needing to drop prices to deal with competition. And so that raises the concern with its valuation. The stock is trading at a price to earnings of 37 and a price to free cash flow of 46. These are premium valuations. This is something like 5 to 6 to 7 times the price of a legacy car company like Ford, Toyota, and GM. And so you're paying this premium valuation for a company that's showing clear signs of competitive pressure. This is not where I would like to be as an investor. I would not want to be investing in Tesla stock right now. All right, so that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.